Two legendary market experts are stepping forward to warn we're in the earliest stages of what they call the Great Unraveling, a specific event starting to take root in America that's behind the recent crash in stocks and the record inflation you're seeing. But they worry it's about to get even worse. And many of the things you take for granted are due for a big disruption in the months ahead. Your Social Security benefits will likely be slashed. Your taxes are probably going way up. And many of your investments are likely to continue falling. Meanwhile, even if you think you've saved enough money to retire, you're probably going to need way more money than you thought. Your personal success all comes down to how well you understand what's heading your way. This is why I strongly encourage you to read about their warning today, totally free. It's all spelled out in a free report we've put together about the Great Unraveling. Get the facts yourself. Go to unravelingreport.com to get your free copy of this report. You can learn how to get their full playbook to prepare for what's coming. Again, that's unravelingreport.com for a free copy of this new report. Hi, this is Daniela Cambone. Welcome to a special edition of the Daniela Cambone Show here in Montreal on the road. We're continuing with our Outlook 2023 coverage. And joining me today, two titans of the space, two people I really have enjoyed interviewing throughout the year, and we're going to get their projections for 2023. So please welcome back Michael Gareth, Portfolio Manager of Toroso Asset Management, also host of the Lead Lag Report, and I should also say the man synonymous with the word few, if you know, you know, folks. And Gareth Soloway, trading over 20 years, founder of Verified Investing Crypto and the co-founder of In the Money Stocks. I also have to say he's been right on the money when it comes to Bitcoin. We're going to talk about that. But first and foremost, gentlemen, how's everyone feeling? How you guys doing?
I'm doing really well. Thank you so much. Good to be here.
I'm looking forward to this year being over. And I feel like I say that every single year, but this year in particular, I really do mean it.
Well, that's exactly how I wanted to kick off this interview. Excited to get this thought. It's not so much a debate, but more a discussion. I know you guys disagree on a few points. So let's see where this goes. If it gets ugly, hey, even better. Okay. I want to start with that thesis, which really has been Michael's throughout the year, of how much of an anomaly it has been. He's basically said it's been hell on earth. Gareth, do you agree with that assessment?
Wow. So I mean, for me, it hasn't been. The year itself has been decent because I'm more of a swing trader, and I think when you're able to go long and short and back and forth, it makes for actually good market action. Bitcoin's been a little different recently. Since June, I would say there's been very little price action except for the two blips on the screen, which were Terra Luna's collapse and the FTX collapse. But in the stock market, it's been amazing. I mean, we've had 15% bounces, we've had 15% drops, so it's been good for traders, I would say.
Good for traders. Well, if I could just sum up some of Michael's key points, and then I'll let you talk to it, Michael. The reason you've said it's been hell, we saw the 20 biggest drawdowns for the S&P going back to 1961. The only year in history where treasuries have lost more money than stocks. And the percentage of weeks that the S&P lost money this year was 63% of the time. You say the last time that happened was 1931. So basically, it can't get worse than 2022.
Well, never say never.
Depression.
Never say never. So a couple things. Actually, Gareth's point is, I think, an important one to focus on, which is that if you were discretionary, this year probably wasn't too bad, especially if you focus primarily on stocks. When I say hell, what I'm referring to is the funds that I manage, right? The ATAC fund family, my mutual fund, Roro, Jojo, which I manage to prospectus, which are quant-based, rules-based, meaning they have nothing to do with me in terms of the decision to rotate offensively or defensively. And the hell has been that defense failed, right? The defense, in my world, based on all the research, based on pure data, based on pure fact, usually long-duration treasuries are the beneficiary of stock market volatility. It's the way to play defense in those drawdowns. This time, it ended up being the source of the volatility in stocks, right? That's hellish because I manage to prospectus. I can't do anything about the way the strategies are designed to operate. And by the way, that hell that I've been very public about in my funds, right, which again, it's systematic, rules-based, Same hell that risk parity has gone through this year. If Ray Dalio would have started risk parity 2 years ago and had a year like this year, he would not have been a billionaire, at this, later on in the future, right? Because this is one of the worst years also for risk parity. Why? Because it's the same problem. Treasuries utterly failed. Now, the good news is you're probably closer to the end of that anomaly, that you probably now are going to be re-entering some degree of normalization. And by normalization, I don't mean a bull market in the stocks. What I mean is, in terms of the relationships of asset classes to each other, looking more like history.
And, I just, if we could take a step back here, let's start, by talking about inflation. Obviously, numbers coming in cooler, but I want to bring it up because you're saying it might not be a sign of bullishness yet. I know when we talk, well, the Fed's going to pivot, also doesn't mean things are going to turn bullish. So first, let's start by both your takes on inflation. Does this just mean the first wave is over? We're not out of the clear yet. Is it time to rejoice? How do you both see it? Gareth?
Yeah, I do think overall inflation's coming down, but my expectation is that inflation will remain sticky for multiple years, probably north of 2%, right? So even north of 3%, I could see it. And eventually, I think the Fed is going to have a moving target on when they'll stimulate. It probably won't be below or at 2%. They'll probably be forced to when we're nearing around that 3% level. But again, there's no doubt in my mind that inflation is coming down. It's just a matter of will it return to that transitory talk back then when it was 2% or less. And I really do not see that for many, many years. I think it's going to put the Fed in a very tough position where they're not going to be able to lower rates for quite a while. And it's going to put a lot of hurt on the U.S. economy.
Michael, do you think we've hit peak inflation?
My response would probably be maybe. Okay, and here's why I say that. I think this is really nuanced. So, to the extent that housing is done for a few years, that's going to be a massive disinflationary, deflationary force, right? Because it's a big driver of economic activity, and most people's asset is their home, and that's where a lot of credit creation comes from. The problem is the number of transactions is going to make it hard to really know where home values ultimately are on average, right? Because while you have what I suspect will be collapsing demand on higher mortgage rates, you still have the dynamic of very tight inventory. So you have this kind of odd equilibrium, I'd argue, in the housing market where people are not going to be buying and people are not going to be selling. So you probably do have much lower mark-to-market values in homes, which would be disinflationary, deflationary, but people wouldn't necessarily see that because the comps are not getting reset lower, right? Mm-hmm. So from that perspective, it's one of those things where it's like, it will feel like inflation in the things that are priced real time. Whereas the things which are not priced real time, I'd argue are going to be much more disinflationary, deflationary. And I do think, keep in mind that if you're going to go back to the 2% inflation average target rate, you got to go past 2% on the downside. Like, this is always what's amazing to me. People talk about you got to get to the long run average of 2%. Okay, well, to get to the long run average, you have to actually probably have a period of outright deflation, because that's math, right? To get back to the longer term average. I find, and Gareth, actually, I'm curious to hear your thoughts on this too. I find this to be really fascinating in terms of how this could play out, because if you're going to have a push towards 2%, if you have a credit event, if you have any kind of crisis, inflation we know lags. So what, the Fed's going to then lower rates as inflation still, from a headline perspective, at 4.5%, 5%, 6%? I mean, the optics of that look terrible.
So that's a good point, Gareth. Any thoughts on that? And does the Fed then tip us into recession, or has that already begun?
Yeah, I mean, I don't necessarily know if we're right in recession right now. I think there's still a fair amount of consumer spending. The jobs numbers, again, lagging indicator, but we're seeing the layoffs in these Fortune 500 companies almost every day, 10,000, 20,000 people. So it's coming. To me, it's like you see that huge tsunami wave out in the distance and you know it's coming. And I do think that, we'll be in a recession in 2023. It's just a matter of, is it the first half or the second half? But to me, there's no way, especially when you think about how the Fed got caught off guard again saying it was transitory, and it's not. Now they've overcompensated to the other side in terms of hiking rates, and I really do believe that they've overstepped again in this direction. But the problem is, based on what happened in the 70s, they're going to be very reluctant to back off and start cutting rates. And so what they're going to do is most likely stay the course, say they have to stay the course. And even when we get in a recession, they're not going to look to cut rates. They obviously won't hike anymore, but they won't be cutting rates for a significant amount of time. And what it's going to do is it's going to cause a spin out on the opposite side then. And it really feels like, I mean, I don't know if Michael gets this sense, but it seems like ever since the Fed's gotten involved in the economy more and more, there's always these huge bubbles and then these huge opposite reactions, right? And it kind of makes sense, right? The universe is supposed to come back to zero-sum game. And so when you have these monster bubbles, you have to have this reactionary period of negative growth to kind of compensate and bring us back to that level. But again, I'm not looking forward to those next few years. I think it's going to be tough. I think it's going to be a traders and investors market. But we're going to have to get through it.
Let me add a couple of quick things. So, real quick on this. So I've made this point before that the Fed is the last great bubble. I mean, the reality is faith in central banks is the bubble, right? But also, I think you hit on something. I know you've been on this point, Gareth, too, for a while, which is that we probably are in a lost decade. And I know that's not really a very popular opinion because it sounds scary, but let's think through this. Bonds have had a lost decade with this drawdown, right? You've undone pretty much all gains, for the last 10 years plus, right? From a just bond fund return perspective. Emerging markets have had a lost decade. They've gone nowhere, right? Just I call it volatile cash, right? Just literally gone nowhere. Yeah, you've had some pockets in the tech space that did well, but you look at the broad-based emerging market indices, nothingness, right, for a decade plus. The U.S. was the standout. Now, why was the U.S. the standout while everything else largely kind of went nowhere? Because of quantitative easing. Well, now that dynamic's gone. And if that was the only real reason, the only real difference between U.S. markets and everything else outside the U.S. that went through a lost decade, and now we don't have QE, I mean, logically dictate what's probably going to be a tough road ahead.
And I think that's going back to Gareth's point. It's perfect, beautifully summed up how you're saying it's really been this game of ping pong that the Fed has been playing. I mean, it's either we're in QE or not. I mean, when was the last time that we weren't involved in this narrative? I mean, obviously pre-Bernanke, but when was the last time that you feel there was less of this?
I feel like the date's 1971, Gareth.
Yeah, exactly. Yeah. I think that's the kicker is that the Fed to some extent has been involved for a long period of time. It really got accentuated in 2009, right? I mean, that was where quantitative easing to a major extent became part of everyday life. And investors have gotten to the point where every time, I mean, it's like a kid, right? A kid falls and they expect their parents to catch them. And I think that's what the market and investors are at. And I do think that that's going to be a major shock. I mean, you're looking at the S&P only down, 15% now from the all-time highs, or maybe not even. And I don't think investors truly understand that when we do go into a recession, there's not going to be that helping hand to get us out this time. There just can't be. Now, when we get into a very bad recession, I think that's when that becomes a bigger question. Will the Fed eventually come to the rescue?
Okay, I was going to ask, is it a short-lived recession? Is it a moment of pain, or?
Yeah, no, I was going to say, I think we're in for a long-term recession. I mean, like a lost decade, like Michael was saying, and I think that's, you can see what's so scary. And again, I've gone over these charts in the past, but if you look at the chart from 1915 to 1930, and we know what happened in the 30s, it's almost identical from the chart 2000 to where we currently are just before the Great Depression. And I'm not calling for a Great Depression. I don't want to be one of those people that goes out that far out. But I think we have to be prepared for something that we haven't seen in a really long time.
And I will get to.
Let me add on that real quick, because I think this is interesting. I used that line on Twitter before. It's only a generational buy when you lose a generation to investing. Right? You have to have people saying to hell with this. Like, by the way, you can argue we're seeing the crypto space, but you haven't seen that in the U.S. stock market, at least. Now, I have to tell you, and Gareth, actually, I want to hear your thoughts on this too, because you're probably closer to this than I am. I got to say, all this manic volume and activity that I see when it comes to zero DTE, 0 days to expiration, options trading, this sort of beyond gamification that's going on in the options market. To me, until that stops, we're going to keep going through just a nasty period. You have to break the speculative fervor. You have to make people so disgusted with the ease with which they can feel the pain of loss because of zero commissions and because of all these, again, kind of very short-dated options, for this to really be a washout. It's more than just the argument of a VIX spike.
And don't you think we're getting closer to that, Gareth, of people just saying to hell with this, and it's not just limited and specific to the crypto space?
Not to be honest, I don't. I mean, comparatively to '09, I don't think we've even come close to that. I still, I was talking to someone yesterday, and this is more in the crypto market, but they were still talking about mortgaging their house to buy crypto. I mean, and that just right there tells me crypto's not bottoming yet. So, I mean, you see this, and I still think that investors are so used. I mean, think about this. We had the COVID collapse in March of 2020, and within a couple months, we were back to all-time highs. So even when investors say, oh, the stock market's down 20% or 25%, in their minds, it's like, oh, don't worry, a couple, 2, 3, 4 months, it'll be back to these all-time highs. And I think that that's the mentality that the Fed has now created, this mentality like, oh, I can't lose, I might be down, but it's a paper loss. And you don't get true bottoms until people fully give up and just say, never coming back. And
please.
Sorry, I was just going to add one more thing. And one of the things that I think is amazingly fascinating in terms of the psychology of investors, after '09, people were so burned that the majority of retail investors did not come back until like 2020. And notice how that was the beginning of the end of the bull market. And we talk about that. I still remember in like 2017 and 18, the biggest kind of headlines were like the retail investor is still not involved in this market. But finally they came back. But again, that was the top. That's where they get burned. And you need to go through a period where now they're going to be gone again for a long period of time.
And we're going to talk to specific sectors and how you can win and what to avoid. And, I want to prepare and educate folks for the new year. But I want to talk currencies now. The euro, the yen, was that the canary in the coal mine for 2022? Michael?
Yeah, I mean, I think you can argue that. I mean, the canary was the decoupling of the dollar as a safe haven play against treasuries, right? I always go back to, there's three main ways of playing heightened volatility in equities historically that benefit from those kind of conditions. Treasuries are number one, followed by the dollar, followed by gold, right? Those tend to be sort of your quote-unquote safe havens in a moment of time. This is one of the most unusual periods in history in that the dollar was clearly the risk-off safe haven. The best inflation hedge ended up being the greenback, while treasuries diverged. Now, by the way, it is interesting to note that if the dollar were to resume its advance, and we saw a pretty sizable decline the last, 6 weeks or so, if the dollar were to resume its advance, which is not impossible, at the same time, long-duration treasury yields keep dropping, then the Fed's going to have to be worried about an event. Okay, I don't, you remember, Daniela, I think I had made this argument to you before that the dollar was acting like there's a sovereign debt crisis coming.
Yep.
And I changed my tune on that at a certain point, as I was saying, melt up October 2nd, conditions favoring a melt up, because I thought to myself, well, it can't be the case the policymakers are that stupid, given how long the dollar had been strong. Dollar then broke, and now we're seeing maybe, some kind of reversal. But, the canary actually is not going to be just sort of the yen or the euro. I think it's the movement of the dollar against the yen, against the euro, but this time coupled with strength in treasuries. That would be the next canary to focus on.
Okay, so just honing in on the US dollar, you're saying it hasn't exhausted, it may not have exhausted its movements yet.
Well, it's funny, right? Because it's like the CPI data comes in softer than expected, and then the dollar falls, which is inflationary. Right? I mean, it's an interesting dynamic when you kind of think through the push and pull here.
Gareth, thoughts on the dollar's direction as we start 2023? Where does it go from here?
Yeah, I mean, the dollar's had quite the fall now from about 115 back to about 100 and just 104, sub 104. So I'm in the camp that we're probably getting close to a technical bounce. But the way I look at it is when you have a big fall off a high, that high now is the peak that I trade against. So until it takes out that peak, that is the high pivot on the dollar. So I'd be in a camp that I look for a kind of a retrace, and then I probably look to short the dollar again, or at least buy things that will go up in a down dollar environment. And by the way, a lot of people assume that the stock market will continue to rally in a weak dollar environment. There will be a turning point where the weak dollar actually is a very big negative for the stock market.
Okay, well, I guess that was my next point is, do we see, you mentioned melt up. Do we see a melt up in 2023? And I also just want to add that Michael says melt up. Again, it doesn't necessarily mean a bullish scenario, but do we see a melt up?
For me, I'm in the camp that we'll see from wherever we close 2022, we'll see at least 25% down in 2023. So I'm in a very bearish stance. I think, again, 2023 should be the year where we finally hit that recession officially, and where the stock market and investors finally realize that the Fed cannot bail us out like they did in 2018, like they did in March of 2020.
Michael?
Let me add to that. Yeah, so I said October 2nd conditions favored a melt up, and I was saying that because my argument at the time was if the bond market volatility were to have persisted, that's the end of the world, right? I said that line many times. The end of the world is the bull case. You can't bet on bond market volatility persisting at these high yields because it means the entire financial system stops. You cannot have your safe collateral acting more volatile than the leverage that's pinned on that collateral, right? The system literally can't function. So it was like a nuclear war bet, right? When there's nukes flying above you, you buy stocks because you'll be dead anyway, right? Then I started pivoting towards the argument that we might be in an environment that favors some kind of a crash, right? Conditions favoring a crash. I said that a week and a half ago. Pinned tweet got a lot of impressions. And it's the opposite argument. It's the end to the end of the world is the bear case, right? Because at the end of the day, no matter what the Fed does or says, the housing weakness is going to take a while to play out. No matter what the Fed does or says, consumers are going to be faced with unemployment rising. No matter what the Fed does or says, there is so much leverage in the system that it only takes a small butterfly flapping its wings to create a tail event. So I do agree. I think it's very plausible, to Gareth's point, you could get a 25% decline. It wouldn't surprise me if you have a big decline into the end of this year. People are assuming that 2022 is over. It's like we forgot that in 2018, we forgot that in 2018 you had a pretty nasty decline into Christmas.
Just a quick point on the housing there. How come the rental space hasn't come down?
Yeah, it's interesting, but it also kind of speaks to how much, probably demand. I mean, think about how many people got priced out of housing, and then how many people are even more priced out now with, how do you get a 30-year yield with 7% interest rate? So I think it just means that you can either be homeless or you got to rent or you got to buy. And right now, rental is still the cheapest option because of interest rates.
How sad is that? Well, I bring this up because Michael and I both live in New York City full time. Now the most expensive city in the world to live in, along with Singapore. Michael, rents are not cheap.
You want me to cry on this video? Is that what you're asking? By the way, let me real quick, because I focus on lumber quite a bit, right? Because it's not some magic thing. It's people say, why do you focus on lumber on Twitter as they tweet from their house, right? I mean, the average home is 16,000 board feet of lumber. It's correlated to housing starts. What's interesting about the state of the housing market here is that as we're chatting, lumber's around $400, right? The historical range for lumber on the low end is $200. You could go down 50% on lumber prices. And that would just take you back to sort of the historical range of where lumber tends to trade around. So I suspect that there's a lot more pain to come on the construction side. Now, by the way, this is kind of, I think, also interesting. There are these lags, right, hitting on rentals. All this is happening with mortgage rates in the fall into the winter, when housing transactions really don't happen to begin with that much. The average consumer outside of this domain, they're only going to realize just how in bad shape housing is come spring, summer, right? Because that's when most housing activity takes place anyway. So there's a delay here, which I think is going to really impact consumer psychology in a big way.
Good point. Want to talk social media a second with both of you. And you might be like, why are you bringing up social media? Well, here's why. And first of all, Michael, I want to applaud you and thank you for saying that, you changed your thoughts, and you're very vocal when you do pivot or change your mindset on a certain topic, you said, Gareth, you're the same. And I think it's so important to remain agile. And it's okay to say, hey, you know what? I've changed my mind on this. Here is how I see things now. I bring this up because, Michael, I like how you said it's almost become ridiculous how people now associate themselves with investments. They no longer just see it as, this is how I'm making money now, but they now identify with certain investments. And I want to just talk a little bit about the dangers of this. And I say dangers. Am I wrong to say it's dangerous?
No, because the problem is if you identify with your investment, that results in overconfidence, that results in leverage, that results in completely poor risk management, and probably results in a big decline at some point, right? And this is what I think is the problem in general with social media. We get into these weird group identities, these gangs, as they call them, or mafias when it comes to particular investment themes. By the way, real quick also, and I'm glad you say this because this is also, I think, what's the problem with social media. And I'm sure, Gareth, you've seen the same thing. The pinned tweet on my Twitter account that, I said, I believe the conditions are there for an imminent stock market crash. Right. I said purposely conditions. The second tweet beneath that, I said, I don't believe in making a call. I believe I'm a weatherman. Right? I'm a meteorologist. The best I can do is identify the weather and then figure out slowing down if it makes sense. I don't know the mile marker that an accident might happen, but I know I need to slow down, right? That pinned tweet got 4 million organic impressions. The second tweet in that 20-tweet thread only had 250,000. So why am I mentioning that in the context of this discussion? The problem is not just people identifying with investments. The problem is people just look at the headline. I know that's not breaking news, but the reality is that I think a lot of people are too busy looking to the right of the equal sign, which is what I say amateurs do. They're not looking at the thought process that goes into why you should be thinking differently about current markets, why you should be not married to a particular investment thesis, because probabilities change, conditions change.
That's right.
Gareth, I say this because all three of us have taken our share of heat. I know you mentioned you got a lot of heat when you were shorting that gas at one point, and various other forecasts you've made.
Hey, Bitcoin too. I mean, it was, and I think the key thing, and what Michael's getting at too, is that like a weatherman, we're always getting new information, and a good investor and trader, first of all, doesn't fall in love with any investment. That's the kiss of death, is when you do that. People have fallen in love with Tesla, with Elon Musk, and then again, you look at where that stock is comparatively, and I think it's even negative again today in a neutral to positive market. But the key is every day we get a new piece of the puzzle, and it's up to us to take that objectively and see how it fits into our overall thesis. And if our thesis changes, then we have to change. Otherwise, you get left behind and you end up losing money.
On the point of Bitcoin, Gareth, I mean, you were right on the money every step of the way with your Bitcoin calls on 2022 and taking heat all the way. I mean, when you were talking 20,000 Bitcoin, people thought you had lost your mind. What's your forecast for Bitcoin as we start 2023?
Yeah, and going back to that call, Michael's been around for as long as I, and the thing is, when you live through periods of these .com bubbles, these other bubbles, you start to recognize the psychological, the signs of bubbles, and it helps make those calls. And a lot of people in the crypto space, this is their first time ever investing, right? So they just were going to be oblivious and kind of get caught up in the hype. But going into 2023, I still think there's more downside. Doesn't mean we can't have a small bounce, but I still think that we probably don't bottom out until May or June of 2023. I've really been likening the FTX blow up to what Lehman Brothers did to the stock market. And I noticed that when that happened, it took about 6 months for the stock market to bottom, and it took another 45% dip in the stock market, in the S&P 500. So I kind of mapped that out, and it gives me a general roadmap. And like we both said here, that's subject to change, but that right now is giving me a general target of around 9,000 and a bottom maybe in May or June of 2023. And I do think that we will get regulation probably in the first half of 2023. It's going to be the best thing that ever happened to crypto over the long term, because transparency will mean that big money will finally start to take a serious look at cryptocurrencies like Bitcoin, and that's the only way Bitcoin's going to see 100K or beyond, is if you get
Sorry,
big money investing.
Gareth, did you say a bottom in May of 2023? Did I hear that correctly?
Correct. Yeah, that's what I'm looking at right now, is a bottom right around that June of 2023.
And then the pain goes away for Bitcoin investors?
No. I mean, just like any market, there'll be a lot of period of chop, a lot of period of testing people's patience where people are just unsure. But I think the 10,000 break is going to be very important psychologically to stop a lot of people out and kind of make them throw in the towel, which is very needed to see a bottom in crypto. And again, you just haven't seen, in all fairness, as much as Bitcoin's fallen, you have not seen the panic out there in Bitcoin or in crypto that shows you a bottom's here yet.
I'm happy you're bringing this up, and guys, please correct me if I'm wrong, because I had a pretty heated interview with Max Kaiser recently, where I was pointing to specifically looking at gold's performance in 2022 versus Bitcoin's performance in 2022. I just wanted to serve facts of how gold and versus Bitcoin did in the face of inflation, in the face of raising rates, in the face of a strong US dollar. Bitcoin down 60%, gold was, closing out the year around down 2%. And Bitcoin aficionados will keep pointing to, well, Bitcoin technically is at an all-time high if you look at the hash rate and buy-in and whatnot. I mean, Michael, what's your take? And am I wrong in, if I had to compare both assets, is there not a clear winner here? And I'm not saying this with any bias. I just want facts. I want, like, Jerry Maguire, show me the money type situation here. And did gold not beat Bitcoin?
Okay, so first of all, to Gareth's point, I always find it amazing that people get upset when somebody argues for lower prices when they should be ecstatic for lower prices, right? It's like, if you believe in something, you want the path to go lower now because presumably you have income to put money to work, right? And average lower for the ultimate higher highs. That's number one. Number two, you lose the argument the moment that you don't define things properly, right? So the problem that I've had with the entire crypto space, and fine, you can argue Bitcoin is different, is very simple. Something cannot be a store of value if it has tail risk, left and right. It's about path. Something cannot be an inflation hedge unless you've been tested in inflation. Something cannot be a guaranteed $1 million price when it's only been around for a decade and there's nothing you can really base fundamentals on. That's not an argument against Bitcoin. It's not an argument for gold. That's an argument that you have to define things properly. I'm going to argue that gold's not a store of value either. And history would suggest, in the very short history of Bitcoin's life, that gold does serve as much more of a proper hedge, meaning it benefits from volatility in stocks, than Bitcoin does, right? So I don't know why it's, first of all, seen as one or the other. I don't know why there have to be these narratives that don't make any sense because the definitions are just not true to the terminology. Call it what it is. It's something that could be something bigger. That's it. And from that perspective, yeah, you know what? It probably makes sense to have an allocation. Not a very large one, but don't get so stuck on these debates about whether it's better than gold or it's just playing off of a different future path. But let's not suck people into narratives that don't make sense, that cause them to do all the wrong things.
Right. So you're saying coming out with bombastic forecasts.
Well, yeah, I suppose. I mean, it's unfortunate, right? Because people want to hear those numbers. They want to latch onto that stuff, especially when it's extreme, right? I mean, it's just the reality. And, that's how you get attention, right? I mean, believe me, I get that game from a content perspective, right?
I get
But
it.
it's more about, I always go back to this point, and Gareth, I think you'd agree with me. It's not about what you own, it's about how much you own of it. The problem with the bombastic type of statements is that it gives people a false sense of confidence that the future is knowable, which makes them take on a larger risk weighting than they probably should.
I bring this up, Michael, because you had a quote once upon a time that said, when investments become religions, it's time to lose faith. When you said that, did you have anything in mind?
Oh, I definitely had crypto in mind. There's no question.
Okay.
I was saying that, and I would argue the same thing with Tesla. It's not just sort of a function of crypto. The whole lumber and gold eyes on Twitter. I put that up around the peak in Bitcoin because everyone on Twitter, every single celebrity, started putting laser eyes. It's like it was so obvious, not even with hindsight. It was so obvious that this was ready to bust in a big way. And it's unfortunate because the warnings were there. People, unfortunately, that are not as sophisticated financially got sucked into these narratives, ended up following the soothsayer on the hill that led them to the cliff.
Gareth, gold, when I interviewed you last year at this time, was your top asset pick for 2022. How would you assess its performance? I mean, you didn't get the close. Well, we still have a few weeks left. You might not get the close you wanted, maybe. But, what's your assessment and how do you see it set up for the new year?
Yeah, I mean, when I talked about gold being the best performer, it was versus the S&P and Bitcoin, and it looks like it will be the best performer between those assets. And I think for me, it's going into 2023. It's going to be my pick for 2023 again. I do think Bitcoin bottoms, but it won't have that significant move up that'll beat gold. And I think again, now that you have the Fed going to the sidelines, or at least moving in that direction versus hiking dramatically, I think that's going to be a benefit. It's going to keep the dollar from really screaming higher, in my opinion. So I think gold will surprise people. And again, I'm a student of history, and Michael I know is as well. And if you go back to the 70s, whether you say it's not quite equal to that what we're going through now or not, it's very clear what gold did, and it had the same sort of kind of initial move up from 2018 to 2020. Then this period of consolidation, even when inflation was soaring in the 70s. And then finally it played catch up in the late 70s and going actually, I think it was close to a 10x back then. I don't think it does 10x now, obviously, but I still think that gold is a hated asset. I love assets that are hated personally. I think that's where money is not in yet, and that's where it will flow and kind of push itself up. So I think gold could be much, much higher, well above the all-time highs in 2023.
Who's it hated by? Wall Street?
Oh, Wall Street, average investors, retail crowd. I mean, again, everyone just is bored with gold. Gold doesn't do anything. That's what you hear. Why are you buying gold and everything like that? Yeah.
Michael?
Yeah, I'll just add two quick things. So you hit on something which I always say, Gareth, which is that you can't be diversified unless you have a portion of your portfolio that you hate. Because why would you hate it? It's not performing. Well, that's the very definition of diversification, non-correlation, right? And gold really is, it's true, one of the true non-correlated assets. It really doesn't move off of most of the things that people think it moves off of when you quantitatively test it. Now, having said that, I do believe that, and I think this kind of lines up, Gareth, with your view as well, you're probably going to have momentum in gold really kick in as there becomes an entrenchment of the belief that the bear market will take a long time to finish. In other words, you need to have allocators believe that there's a duration element to the correlations of equities and risk assets to each other for there to be at the margin some kind of reallocation to the diversifier gold, right? So I think the more time that the bear market plays out in stocks, the more beneficial it'll be just to kind of get that momentum trend going.
Just on that point, Michael, if gold were to catch a bid, and we've all heard this narrative, once gold takes off, so will the miners. But I know, Michael, you've said not so, and you look to history to disprove this theory. Can you talk to us a little bit about this? What do we do with the miners if that's not the case?
Yeah, I mean, actually, this is important because I tried to create a strategy around this to maybe even launch an ETF around the idea. It's not to say that that something doesn't exist, but I'm talking from the standpoint of somebody who actually backtested it. The argument that gold miners follow gold is just not true. It's just factually, it's not. It's not a levered play. I mean, maybe I'm missing something in the delayed spillover effect of gold's price movement to the miners, but miners also respond off of oil prices because it's very energy intensive, obviously. So there's other factors that kind of play into that as well as geopolitical risk, currency risk. So it's not as clean of a sort of argument that as gold goes up, gold miners should go up. Now, having said that, miners are just as hated as gold, right? And from that perspective, yeah, I mean, miners probably do work as well. The thing is, I'm sure as everybody knows, gold miners in particular, they tend to be wildly volatile. So if you're really going to play in that field, or you got to really size that even more appropriately than everything else.
Gareth, do you see that in your technical analysis that miners don't always trade like gold?
Yeah, and we saw that quite a bit we really saw an underperformance in miners. Like Newmont Mining got crushed early, all the way into pretty much late. And the kicker there was that you had this high inflation rate that was causing all their input costs to go up dramatically, whether it was labor or technical gear and everything like that. And gold wasn't going up, right? So when gold doesn't go up, but their costs are skyrocketing, that really hurts the miners, in terms of profitability. Having said that, if inflation is really coming in, but gold starts to take off, that would be the case where they would actually outperform quite a bit. And like Michael said, just be ready for that volatility because they are very volatile.
Got to get in a question here about silver right now, beating gold as we speak. Do either of you like silver as a play right now?
I mean, I'll what I'll say about silver is that silver is more correlated than gold is. So just because the industrial cyclical components of it. So if you're going to do it for a trade, I think that makes sense. If you're doing it as a replacement to gold, I'd argue that it serves a different role in the portfolio.
Yeah,
Gareth,
I'm in the same. Yeah, I'm in the same camp as that. I think the industrial side makes it more vulnerable to a global recession, domestic recession. But ultimately, I still think it trends higher. It's just going to be more volatile due to those kind of industrial sides.
So with so much depressed out there, how vital is cash right now to be scooping up deals?
I'll let you handle that, Michael. Why don't you go?
I mean, cash worked this year, but cash for the most part really doesn't work. So this is it's funny you say this because this is kind of is a bit of a pet peeve for me. All right, the problem with cash, which is what's consistent with all the market timing studies, right, is that cash doesn't allow you to be wrong with your signal and have a chance at making money. It's actually quite the opposite, right? Because inflation's eroding cash. The problem with shorting, and I know, Gareth, you do it well, and it's different when you're discretionary, but the problem with shorting, especially if you're systematic, is that if you're wrong with your signal, it's even worse, right? You lose money. You can't be, it's a horrible thing from a backtesting perspective. If you are in long-duration treasuries, except this year, right, notably, if you're in low beta sectors like utilities, staples, and healthcare, you can be wrong playing defense, but you still have a chance at momentum. You still have a chance at compounding. It's not a perfect inverse correlation. You have some component potentially of making money. So cash worked this year. The argument that it's good to have cash as dry powder, to me, it's like, all right, that worked this year, but if you do that any over any sustained period, it really doesn't. I think you're much better off, in general, always taking a chance, even if that chance still, with hindsight, means you're at a loss, than not playing the game at all.
Look, we covered a lot of ground today, so as we're wrapping here, just want to get some clear direction for the folks listening at home. Any outliers you could see as we head into next year, things that you're watching and looking at and thinking, this could explode. Gareth?
For me, it's starting to look outside of the U.S. I still think the U.S. is going to have a lot of trouble, but I think there are countries out there that have been underinvested by most institutions for many, many years. And I think they're going to be the recipients of money flow. So, I'm definitely focused in on South American economies and their markets, Brazil, the EWZ. I think China is definitely interesting, though very risky. If we are seeing the end of zero COVID policy and maybe a warming up in relations, you have some stocks over there that are just incredibly discounted. Even after their recent really big run. So I think that's where I'm kind of focused in on, plus gold miners, being defensive, and then being more of a trader in 2023.
And Gareth, Michael, how about your thoughts on the rise of the BRICS? I mean, we're seeing more countries being added here, countries looking to solutions outside of the US dollar as a payment solution. Is that something you're watching?
Yeah, and look, there's a price for these areas, right? I mean, despite all the geopolitical concerns, I mean, presumably there's going to be momentum at some point. I mean, emerging markets, there's the old saying of 7 years of famine, comes before 7 years of feast. I mean, in this case, it's been 10 years of famine. You can argue for emerging market investors, but at some point, you've got to assume, I think, that to Gareth's point, money will flow there. I will say that I think the real thing to pay attention to next year, and it kind of lines up nicely with Gareth's point about maybe a 25% drawdown, from here, is that at some point there's going to be some really, really good opportunities in the high yield junk debt part of the bond market. One of the things which has been so maddening about this year is that everyone talks about bonds doing poorly, but credit spreads largely stayed pretty tight. I meaning that you didn't really see sort of these blowouts where default risk kicks in. There's an overreaction in the very levered high yield players that you can then scoop up and capture that yield on when you factor in the real default rate, right? So at some point, and again, that's consistent with more classic risk off, you're going to get a real opportunity to scoop up, I think, some really high yielding paper. It's just not here yet. And it's one of those things where it's kind of like the definition of profanity. You know it when you hear it, you'll know when you see it when it comes to the bond market.
So what would be the top sector for you in 2023?
Can I tell you in 2024? Well, and I say that because it's like you never really know with this stuff. Look, I mean, I'm a believer in the energy thesis and the underinvestment argument, but the problem is I think also it's now almost too obvious. Technology, I'm not a huge fan of because if you're technology, you're pretty much the market. So I don't think you get much differentiation from that perspective. I mean, the reality is
Fair enough.
It's probably going to be healthcare. I mean, I don't know about everybody that's listening to this, but I'm pretty sure that the stress level that this economy is giving us makes everybody much more likely to be a patient.
Gareth, is it too early to reveal what your top asset for 2023 would be? Or can you tell us now?
No, not at all. No, and just like in 2022, I do think in terms of versus Bitcoin and the S&P, and I'm not gonna, who knows about other smaller assets out there, but I do think that gold will be the outperformer again this next year. Following that, it might be Bitcoin after that.
Very nice. Well, before we wrap, top of your wish list. What's on the top of your holiday list? Do you have any things you'd really like?
For me, it's just kind of, again, it's being a trader. It's looking for these big dumps. I'm actually looking right now. I'm beginning to short the S&P 500. I'm not really doing much ahead of the Fed, but for the most part, I'm looking to short the S&P, getting ready for the downshift that I think is going to come. Looking to short Apple. I think Apple has a major trend line. I think it's around 136 or so. If that breaks, that is going to be an epic break of a trend line. So I think that takes the market down by itself. And I still can't get over, and again, Michael, you probably remember this, back years before the Fed was really doing QE, PE ratios for companies growing like Apple, I mean, you were talking about tens, in the 10 range. And here we are with Apple at 25.
Yeah.
And I just can't get over that long term.
Michael, any final thoughts?
Yeah, I'd love for the just so I don't get the inevitable pushback if it doesn't happen, for my argument that the conditions favor a crash. It'd be nice to actually see some kind of a shock decline. Not because I'm calling for it, but because I believe people need to be reminded that you have to focus on the weather. And I'm going to argue to everybody that the best thing that can happen to really stop the insanity is for markets to humble every single person that's out there. I've used that line many times before. Bear markets make fools of bulls and bears. Do not take the end of the year for granted.
We could definitely all use a little dose of humility. Never hurt anyone.
The market
Gentlemen,
humbles everybody, just not at all at once. Humbles everybody.
Well, I hope all your wishes come true. I thoroughly enjoyed this discussion. I'm always learning. Michael, Gareth, happy holidays. Thank you.
Thank you.
Likewise.
And thank you all for watching. We hope you are enjoying our Outlook 2023 series. We will have more great content coming your way, so be sure to stay tuned. That's it for me. Thanks for watching.
Opinions expressed on this program are solely those of the contributor and do not necessarily reflect the opinions of Stansberry Research, its parent company, or affiliates.